Imagine a financial system built to help ordinary Americans buy homes collapsing spectacularly, costing taxpayers hundreds of billions of dollars and leaving a trail of fraud and scandal. This isn't the 2008 financial crisis. This is the savings and loan scandal, a forgotten chapter in American financial history that exposed how deregulation, greed, and political connections can destroy a system. How did a government-backed institution designed to provide stability spiral into one of the largest financial disasters in U.S. history? Today, we will uncover the origins, rise, collapse, and lessons of the savings and loan crisis, a story that foreshadowed the mortgage meltdown decades later. The Savings and Loan Associations, or thrifts, were once America's backbone for home loans. Founded in the 19th century, they were small, local institutions where Americans could save and borrow for mortgages. By the 1970s, the system was under pressure. Inflation surged, interest rates skyrocketed, and many thrifts were unable to compete with commercial banks. Deregulation began to creep in, aiming to liberate financial institutions from restrictive rules. Key players emerged. Charles Keating, who would later symbolize the scandal, politicians in Washington, some unwitting, others complicit, regulators struggling to balance growth and safety and oversight. And as we'll see, the seeds of widespread fraud were being planted in the corridors of power and the boardrooms of thrifts. The 1980s brought dramatic changes. Deregulation, the depository institutions. Deregulation and Monetary Control Act of 1980 allowed thrifts to offer higher interest rates to compete with money markets. Expansion of powers. Thrifts could now invest in riskier commercial real estate, junk bonds, and speculative ventures. Initially, some saw opportunity. Thrifts were no longer confined to home mortgages. Big profits were possible, and many were willing to chase them. But with opportunity came temptation. Many thrift executives over-leveraged their institutions, ignored warnings, and engaged in outright fraud. By the mid-1980s, the crisis was building. Charles Keating's Lincoln Savings Loan became emblematic of the scandal. Thrifts invested heavily in speculative real estate projects in Florida and California. Loans were made to shell companies or insiders, often without collateral. The federal government initially encouraged risk-taking, believing it would stimulate economic growth, but the results were catastrophic. Thrifts collapsed at unprecedented rates. Fraud and mismanagement were rampant. Millions of Americans lost their life savings, and the government faced mounting pressure to intervene. The first wave of failures shocked the nation. Regulators discovered massive accounting fraud, hidden losses, and insider abuse. Charles Keating's Lincoln Savings became the poster child. Over $3 billion in fraudulent loans, political lobbying, and corruption. Politicians were implicated, leading to public outrage. By the late 1980s, nearly 1,000 savings and loan institutions had failed, costing taxpayers over $124 billion, equivalent to hundreds of billions today. Congress and the media labeled it a national scandal, but for many Americans it was already a personal tragedy. Lost homes, savings, and trust in financial institutions. The government responded with massive intervention. The Federal Savings and Loan Insurance Corporation, FSLIC, was overwhelmed. Emergency funds were allocated often after the damage was done. New regulations and oversight mechanisms were introduced, but some argued the reforms were too little, too late. Critics pointed out systemic failures, lack of early warning systems, conflicts of interest between regulators and politicians, overconfidence that markets would self-correct. Even decades later, analysts note that the S&L crisis foreshadowed 2008, proving that lessons from history often go unheeded. The parallels are striking. Deregulation, speculative lending, systemic risk, fraud, insider deals, loss of public trust, government bailouts, and moral hazard. Sound familiar? From subprime mortgages in 2008 to meme stock trading and cryptocurrency manias today, the human patterns repeat. Greed, herd behavior, and blind optimism combined with poor oversight. Shocking data. The S&L crisis cost over $124 billion in 1990 dollars, tilde $250 billion today. In 2008, the government spent trillions, a scale 10x larger, yet the root causes were eerily similar. History is not just about numbers, it's about patterns. And the S&L crisis teaches us that ignoring early warning signs can be catastrophic. Takeaway 1. Deregulation without oversight is a dangerous experiment. The S&L crisis proves that opening markets without safeguards can lead to disaster. Takeaway 2. Human greed and short-term profit motives are constant. Scandals may change names, but the psychology remains. Takeaway 3. History is a teacher, but only if we pay attention. From the S&L crisis to 2008 and beyond, the lessons remain relevant. Warning. Trust in financial institutions should be informed by history. Speculation and unregulated innovation can create wealth or catastrophic loss. Call to action. Subscribe for more deep dives into financial history, scandals, and the hidden forces that shape our economy. Hit the bell to uncover the stories that reveal the lessons history tries to teach us.